Back in July, after Tesla reported its second quarter results, the stock price shot up on a much better than feared outcome. Tesla managed to turn what was supposed to be a very negative 3-month stretch into not a bad quarter at all. Despite major shutdowns in Shanghai affecting not only their China business, but also all of their factories that source at least some parts from China. Giga Berlin, for instance, has been dependent on Tesla China and China suppliers, while the Gigafactory transitions over time to more locally sourced production. Tesla nonetheless earned $1.95 per share, which while down sequentially, was still much higher than what Tesla reported even just 3 quarters earlier when the factories were running rather smoothly. This begged the question that if Tesla could pull off a decent quarter in the face of major headwinds, literally their most productive factory being completely shut down for a month, along with other China component makers going offline and rippling through their entire supply chain, then now that this is behind us, what could Tesla's earnings look like if they can just have a regular quarter with no major disruptions? Tesla stocks subsequently moved higher over the coming weeks after earnings, into the $900 range, which is now equivalent to $300 per share, adjusting for the recent stock split. However, the shares have come down as of late, in part due to a new set of worries about China. The United States has banned Nvidia from selling its A100 and H100 chips in China, and these chips are mainly used to train artificial intelligence systems. For instance, in the US, Tesla has a supercomputer cluster of these exact graphics cards, the Nvidia A100s, in order to train its neural networks for developing its full self-driving systems. According to CNBC, however, this ban on the sale of these chips to China doesn't affect Chinese electric car companies for now, which use Nvidia's Xavier and Orin chips. But the article may be confusing these latter chips, which are used inside the vehicle, with the A100 chips which are used inside the data center. Now, even though Tesla isn't directly affected by this ban as far as we know, Tesla is building their own Dojo chips and training units which are meant to effectively replace the Nvidia GPU clusters. Dojo is still in the early phases, so it isn't like Tesla was planning to be selling these chips in China, so they're not affected by this ban. Nevertheless, it is worrisome that China may retaliate, and this could in turn affect Tesla in a different way. And Tesla has what is now a massive business in China and relies heavily on its Gigafactory and on local suppliers in order to help power its global EV business. Moreover, investors have seemingly been a little too positive on Tesla in the past few weeks, especially on the back of the recent stock split. While the stock split itself has no real effect on the company in the long term, it is a bullish signal to investors. Looking at Tesla's last stock split, which was almost exactly 2 years prior, on August 31st, 2020, Tesla rose 12% that day. It seems like investors were expecting an encore, but instead, Tesla stock actually fell after the stock split took place on August 25th, 2022, which may be a sign of being perhaps temporarily overly bullish. If everyone is expecting the stock price to go up, then there's no one left to buy after the news occurs. But now things seem to have changed, with increased worries that China is looking more volatile, and this signal that Tesla stock fell after the split befuddling investors. These negatives may actually be a good thing as the market waits for more certainty. It gives Tesla the opportunity to beat expectations in a shaky market, since in the meantime, there are too many good things happening at Tesla to ignore. And by the way, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and financial data going back 10 years, and it's all freely available. There are multiple catalysts in the second half of this year that should bode quite well for Tesla going forward. Let's touch on just 3 of them. Tesla's 4680 ramp-up is key to the company's success, especially next year in 2023. While Tesla has given out a handful of direct clues as to where the 4680 ramp stands, they said that it's growing at a crazy 35% per month at their Kato Road facility. We can also draw some conclusions from the actions the company has taken with the semi-truck. It seems like Tesla may be pivoting to get the Tesla Semi out to market faster. It appears that their battery capacity for 2170 battery cells, these are the traditional cells found in the Model 3 and Model Y, have increased dramatically thanks to third-party suppliers. Tesla makes their own 2170s at Giga Nevada, but they've also been asking their suppliers to boost or double production, basically make as many batteries as they can, and Tesla will buy them. And it seems like these suppliers are starting to come through for Tesla on this front. This may have enabled Tesla to do something rather strange, which is switching the Model Ys made in Giga Texas from 4680 structural packs to 2170 non-structural packs. This seems like a step backwards because Giga Texas is supposed to be ramping up 4680s, which should help propel Model Y to be the #1 selling vehicle in the world, according to Elon Musk. But on the other hand, it does seem like a bit of a waste to put these state-of-the-art batteries into Model Y, which also supports the older 2170 form factor. Some of Tesla's other vehicles, such as the semi-truck and the Cybertruck, according to Tesla's Battery Day event, require the new 4680s and have no 2170 battery pack alternative as far as we know. And so these initial 4680 Model Ys has allowed Tesla to get some initial 4680 based vehicles onto the road for validation that these batteries are indeed ready for mass scale. But now using 2170s for Model Y frees up all of the 4680s for the Semi, which actually needs them, followed by the Cybertruck next year. The semi-truck, for instance, won't work very well with 2170s, which could limit range and other specs. Have a look at my recent Tesla semi-truck video for more details. Now, it should be noted that not all 4680 battery cells are created equal. According to the limiting factors 4680 cell teardown, there was no silicon found in a very early version of the battery cell that they tore apart. Silicon is used to increase energy density, as it can store 10 times more energy than graphite, though it also contributes to lower longevity since it expands and contracts with each charge and discharge and causes more battery degradation over time. But the point here is that the semi-trucks need Tesla's best state-of-the-art battery chemistry, and that's not what was going into the Model Y, at least not the early versions. So perhaps Tesla is now prepared to augment their battery chemistry, at which point it no longer makes sense to put that into the Model Y, at least not for now, but instead shifted to the Semi, which is why Tesla brought forward the Tesla Semi's first delivery targets to this year in 2022. So this could end up being very positive for Tesla that the ramp up of 4680 cells is going quite well, and that Tesla has enough batteries to introduce a new vehicle model and also maintain their current lineup specifically for the Model Y. The Tesla Semi would therefore be incremental to Tesla's earnings and would increase the average price per vehicle for the company, even if it uses more batteries than the other vehicles. Again, it's incremental to earnings as long as Tesla can satisfy the other vehicles with batteries and launching the Semi isn't taking away from them in any way. Another interesting catalyst is Tesla increasing the price of its full self-driving software to $15,000 from $12,000 on September 5, 2022. Tesla's FSD software continues to make large strides in the field of AI and getting closer to becoming safer than a human driver. This price increase has a number of implications, including a show of confidence that the latest releases in software have indeed been a step up as Tesla plans for deploying a robotaxi network in the coming years. While stock market analysts are disregarding anything to do with a robotaxi network in their Tesla valuations, FSD should be viewed as a call option for Tesla achieving this milestone, and call options could have significant value, especially given the potential for this type of innovation when it eventually enters the market as a real product. Tesla's latest FSD beta updates continue to show progress of closing in on this goal, which should make this call option more valuable as certainty increases. Additionally, increased prices means higher revenue for Tesla if take rates remain the same, and the improved software should be more enticing to new customers. The value of FSD that customers pay is already baked into Tesla's financials, but Tesla also has a bucket on their balance sheet for deferred revenue related to FSD, which is on the order of $1 billion. The price increase in FSD signifies that Tesla could recognize a larger portion of this deferred revenue as it continues to deliver on milestones related to full self-driving, which would further increase Tesla's revenue. And this, along with the 4680 ramp, relates to the third catalyst, which is Tesla's earnings itself. Investors no longer seem to be impressed with Tesla's most recent quarter, the second quarter of 2022, in light of the stock price dipping back down to levels just after the quarterly data was released. This is one of Tesla's most difficult quarters since the pandemic began, with shutdowns in China affecting Tesla's worldwide business. Yet Tesla delivered 254,000 cars. It's an impressive number, but this is down from the 310,000 that Tesla delivered in the first quarter, but still up about 25% from the prior year when Tesla delivered approximately 200,000 vehicles. Now first, what's interesting is how much money Tesla made compared to last year. With just a 25% increase in vehicle sales, their GAAP net income grew by a staggering 98%, effectively doubling. Now this is on the back of a 42% increase in revenue, and this could be attributed to higher vehicle prices, and Tesla did sell more Model S and Model X vehicles than they did last year, and these are premium priced. Their expenses only increased by 13%, which further helps Tesla's leverage, so a small increase in vehicle sales led to a large increase in net income. Now let's look at the previous quarter, Q1 of 2022, which was an all-time record for Tesla, and use this first quarter as a reference. Tesla sold about 55,000 fewer vehicles in the second quarter. This caused revenue to drop about $2 billion. Gross margins fell 4%, operating margins down about 5%, everything fell, and Tesla earned $1 billion less than the record first quarter. But to me, this shows Tesla's insane leverage and their incredible earnings potential and cost-cutting ability, especially as they sell more vehicles. In the second quarter, it's estimated that Tesla missed out on the order of about 100,000 vehicle deliveries from China just from being shut down for about a month and taking time to ramp back up during the rest of the quarter. This means that now that Tesla's factories are back up and running, Tesla should have almost a full quarter of solid deliveries. But what they did was they purposely shut down the China lines again to upgrade the factory further in the current quarter. This is a short-term hit that Tesla will recover from for long-term benefits. According to reports, Tesla delivered 77,000 electric cars in August from the China facility on top of about 30,000 in July when the upgrades occurred. And typically September, which will conclude the quarter, should be the best month assuming no disruptions. This could get Tesla near 200,000 units just from China alone. Adding in Fremont firing on all cylinders and Giga's Berlin and Texas ramping up production, and Tesla should have another record quarter and deliver even more cars than the 310,000 from the beginning of this year. The first quarter of this year was insane. They made $2.86 per share at the time, or over $3.3 billion. At $300 per share, this would mean that Tesla is trading at 68 times normalized earnings given this run rate. While this earnings multiple seems high, it's not when you consider Tesla's 98% growth rate as previously mentioned, but it's possible that this gets significantly better in the upcoming quarters as earnings continue to rise. In addition, Tesla also reported $142 million in losses in the second quarter, which further impacted their earnings. This is largely behind the company now, as they took a Bitcoin impairment charge for unrealized losses on the value of their Bitcoin investments, and they also laid off employees to the tune of $36 million in the last quarter. This may spill over to the third quarter, but actually Tesla is left with a much leaner version of themselves, which should help earnings in the quarters going forward, especially combined with the highest number of vehicle deliveries we're yet to see. Elon Musk actually has a very good track record of running a tight ship and keeping costs low. The analysts on average are expecting Tesla to earn 91 cents per share in the upcoming third quarter, despite the first quarter of the year earning 95 cents per share. The third quarter should be better than the first, but it's good that expectations are low. With FSD prices beginning to go up, semi-truck on the way, signaling that 4680s are ramping nicely, and a leaner Tesla, we may actually see Tesla's true production without too many disruptions. If Tesla delivers more vehicles in the third and fourth quarters than in Q1, it's likely that their earnings power and leverage will allow them to far surpass the first quarter's earnings. Thus, Tesla could have a spectacular second half of the year, which could propel the stock much higher. So do you think Tesla will deliver more vehicles in the upcoming Q3 than the 310,000 vehicles they delivered in Q1? And if so, will earnings end up being higher due to the factors mentioned in this video? And what other catalysts could help Tesla between now and the end of the year to further improve their earnings? If you enjoyed this video, have a look at my last Tesla Semi and Cybertruck videos to further hear my take on these upcoming vehicles. Please hit the like button and subscribe, we would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.